You ask me for $1 and I say, okay, we're going to do a loan for you and I'm going to charge you 100% interest on the dollar and I'm going to give you a year to pay it back. Okay? How much are you going to pay me at the end of the year? $2? $1? 100% interest, 1 year, $2. Right? Did everybody get that? It's pretty simple, right? That's why they call it simple interest. It's simple. It's really easy. I borrow $10, I pay 100% interest, I give you back 20. Okay? Now compounding interest is something totally different. And essentially this is how it works. Harold says, whoa, whoa, whoa. First of all, I don't need a year to pay you back $1. And number two, I don't really want to pay 100% interest. Isn't there something we could work out? I say, great, no problem. I'll work something out for you. Instead of 1 year, let's do 6-month terms, 2 6-month terms. We break it in half, okay? Now I'm still going to keep the interest rate at 100%. It's just that I'm going to give you an opportunity to pay me back early, okay? So at the end of 6 months, you've accrued 50% interest on the dollar, which means you owe me $1.50. Is everybody with me? Okay. Now if Harold comes to me that day, as typically can happen, somebody says, hey, you know what, I got $1.45, but I don't have $1.50, you know, you take the $1.45, I'm going to say, you know what, that's not the deal we had. The deal was $1.50 or nothing. So here's what's going to happen, Harold. We're going to start the new 6 months. You keep your $1.45, and we're going to start the new 6-month term at $1.50 balance, and I'm going to charge you 50% of $1.50 for the next 6 months. So now you're going to pay me 75 cents more, which means at the end, you're not going to pay me $2, you're going to pay me $2.25. You with me? Did everybody understand that? Really important. Okay, quick yes or no. Yes? Okay. So $2.25, that's the effect of compounding on $1 over 1 year. Imagine $220,000 over 30 years, okay? So you can imagine most people can't pay their mortgage back in the first 6 months, so the interest that's accrued adds up and they charge interest again. Okay, that's compounding, and that effect makes it go really, really fast. Now open your books for a second, and on that card, we do what's called an awareness test. Flip over that card on the back. Here's what I want to do. I'd like to know, how many of you have a mortgage? Hands up if you have a mortgage. Okay. Some of you maybe have multiple mortgages. For this test, I just want you to think about your primary mortgage. So the residence that you live in, the primary mortgage that you have. And if you don't have one, just pay attention and listen, and no stress there. Here's what I want you to do. I want you to take 30 seconds or so, or take the rest of the night. I want you to try and think about the details of your mortgage, because I want you to be aware of what you're not aware of. You should know all the details of what is, for most people, your largest liability and the most aggressive interest-bearing debt. But unfortunately, most people don't. And here's why. We were never taught any way to manage a mortgage. Everybody's winging it. You know, when you go to high school, knowing what I'm about to show you now, you'll probably agree at the end. Everybody should be taught how to do this, because almost everybody's going to have a mortgage. And for almost everybody, it's going to be their largest liability and their most aggressive interest-bearing debt.